Hey everyone, today I want to spend a couple of minutes looking at my personal top 3 ways to play defense in the stock market. I'm going to give you 3 things and we'll look at the pros and cons of each 3 ways of doing that. I may even throw a 4th bonus thing in there as well as a 4th way to play defense. Now, when I talk about defense, I always come to this one of my favorite and famous quotes that you may have heard before, which is to say that defense wins championships. It's an old football quote from a football coach, American football, and basically my interpretation as this translates into the stock market is that if we can play good defense when it's time to play defense, meaning when things are choppy or bearish, like kind of right now, it allows us to play much better offense when it's time to play offense again. So first of all, we need to have an idea of like when things are getting more choppy. And so one way of looking at that is looking at the interest rate environment and the inflation environment. And of course, we have inflation still going higher, a lot more, I think, in terms of the gamma. We may have reached the acceleration top, but inflation is still going higher. And as a result, interest rates are going higher. And when that happens, you get risk-off moments. So that's the big thing. The other thing we need to do, and I'll go into the chart, we need to have a tool or a way to kind of frame a framework when things are no longer bullish. And you can see this is our trend following model on Meta, Facebook. And you can see how the stock was no longer bullish as of January 4th. Then it went to a neutral period. So it basically meant don't buy it, don't do anything with the stock. And then it went into bearish, and of course the stock has now fallen apart. So that's important as well, is to have some sort of framework within which to kind of look at markets from a trend perspective. So I'm just going to bring up a random chart of the NASDAQ 100, which isn't really what I want to talk about here. But the first number one way in which you play defense, in my personal opinion, is just to raise your cash levels. Now, the benefit of that is, of course, that you have less money exposed to the markets. But of course, cash does have a cost, right? There's an opportunity cost, especially when you have an inflation environment. So yes, you can raise your cash levels, but you're not going to earn any money on that cash. So on one hand, you can say, okay, I'm in cash, which is good because you're not exposed to the market volatility. So you're less exposed to potential losses, but because of inflation and because of interest rates, there's an opportunity cost. So you're basically in a situation where you're not earning anything on that dollar or that euro, whatever your currency is, that you have in cash. So I like this strategy from a multi-month perspective. I don't want to be in cash for too long. But for a little bit of time, a few weeks, a few months or so, I think that's okay, in my personal opinion. The second way to play more defense is very simply to buy something like gold. Now, if you look at gold just year to date, this is the gold futures chart, you'll see that even though gold hasn't really gone higher, it also hasn't really actually gone lower this year. So it's been a pretty good defense environment. And I'm going to quickly just show you this, what it looks like in relative terms. So this is the relative chart of gold versus the S&P 500. And you can see it's held in pretty well. So it's up year to date versus gold, versus the S&P, and it has almost none of that volatility. Of course, it hasn't gone higher either, or not much. So what's the benefit? The benefit of being in gold is it's less volatile when it comes to playing defense. The drawback is that if it doesn't go higher, it doesn't go higher, and more importantly maybe is that there's no yield. Just like cash, there's no yield. And so, again, there's a potential opportunity cost that you're missing out on, meaning you're sitting in an asset that has no yield. And some people that are very bullish on gold as a general theme would say, well, it doesn't need a yield because it's a great inflation protection. And I do agree with that. I'm more talking about being in cash for a few months as opposed to allocating to gold for 10, 20, 30 years. It's just a different way of looking at it. So that's another way, I should say, of playing defense. A third way is, I'm going to go back to the NASDAQ 100, is just to be short, like buying puts, right? So you look at the NASDAQ 100 here right now, the QQQs, you can see we've broken some trend lines, yada, yada, yada. You think we can go lower. The benefit, of course, is if you buy some puts or you go short or you buy an inverse ETF, right? The benefit is that if the stock market does go lower, you could potentially make money. The second thing or the drawback to that is it's much more nervous. We know that in bear markets, most people don't make money. Even the bears don't make money in bear markets. And it's because they tend to be so difficult. So if you look at just, for example, here recently, even though we had a decent correction in the NASDAQ 100 down about 17%, we did just have, up until a few days ago, a counter trend rally of 10%. And so a lot of times that volatility tends to get to people's head, and then they end up not making money on the shorts or their puts because the volatility took them out of the market. Those are the top three things. I have one more way of looking at it, and playing defense, and that is using consumer staple stocks. Now, this is also a somewhat imperfect way of playing it, but the benefit, of course, is you're in consumer staple stocks. The XLP ETF is one way of doing that, and the XLP ETF will invest in companies like Procter & Gamble and things like that are more steady, meaning the kind of things that are a little bit that you're not going to stop buying. Like you're not going to start buying, let's say toilet paper, for example, or toothpaste, right? When things are in a downturn. So that's the kind of the benefit of that. And if you look at the XLP, the Consumer Staples ETF, and you were to divide that by the S&P 500, then again, year to date, this is very promising. You can see we've had great relative outperformance year to date, or not great, but some relative outperformance with less of the volatility. What's the drawback, you say? Well, it's still an equity, and if you have a real sell-off, these stocks could certainly go down. So it's not like it's a perfect hedge.